Hey everyone, welcome in to another daily editorial here on the KE Report. I'm chatting with Jordan Roy-Byrne, founder and editor of The Daily Gold. Now, we are recording this a little after that Fed statement, and well, we've gotten some more volatility on the back of that Fed statement, and Jerome Powell's press conference is still ongoing. We're not going to focus too much on what the Fed statement, the rate hike, or this volatility that we have seen just today. I want to more talk big picture with you, Jordan, when it comes to not just looking at the gold sector through a vacuum, looking at the big picture here, and one of the keys being how gold is performing to the underlying U.S. equity markets. We'll use gold versus the S&P. Why is this important to watch more so than simply the price action or individual levels on the gold chart?
Well, I mean, there's a short term and a long term answer, but in the very big picture, grand scheme of things, if we look at all of the best moves in precious metals, other than for a period in the mid 1960s, all of the best moves occurred while the S&P was in a secular bear market. So you look at the period 1929 to 1942, 68 to 82, 2000 to 2011, all of gold's best moves, gold and or gold stocks, were in those periods, except for once in the mid 1960s. And even in that period, the S&P did, it was in a secular bull, but it didn't perform that well. It was at the tail end of that secular bull. So, I mean, if we think about that, it really simplifies the very big picture. And I mean, you can think even if you're looking at it from the perspective of you're a mainstream financial professional, you would say, well, the S&P performs best, when gold and commodities are in a secular bear. And so to take it one level further, Corey, if you're looking at the last 100 years, you have had significant multi-decade breakouts in the S&P and in gold. So if you look at charts of, and again, gold, you could use commodities before gold was fixed, but there's very significant breakouts in both of these markets. I mean, for example, in the S&P, I believe if you go back to, I want to say 1950 or so, or 1948, 48, somewhere in there, if you look at the S&P, it had like a 13-year breakout there in that period. So that was very significant. That signaled that you're in a major secular bull for the S&P. And of course, we all know the same thing happened with the Dow Jones in 1982. And, to the S, depending on, how you look at the S&P, it had a similar breakout there at the same time. And then you look at 2013, the S&P had a very significant breakout from 13-year resistance. So all these moves basically catapulted the S&P to significant gains over the coming years or over the years that followed. And the same thing happened with, gold and commodities. You go back to gold, you look at 1971. I mean, sure, the price was fixed before then, so it was kind of artificial, but gold was trading under $35 to $40 an ounce for decades. Then it was let go, it was floated, and of course it surged much, much higher. That was that bull market. And you look at what happened in the 2000 to 2011 period. To me, the real significant breakout is it was a breakout of a downtrend line in 2005. And gold's that bull started in 2001. Gold had some small gains when it started. The stocks were doing a lot better. But when gold broke that 20 plus year downtrend line in 2005, the end of 2005, it went from the low to mid 400s. It got to 700 pretty quickly. And then a year or two later, it was already up to 1,000. So that to me was a very significant breakout at that time. And with respect to gold, we're coming up on 11 years since the 1900 peak in 2011. So gold is setting up, the S&P is setting up for a secular bear, and gold is setting up to break out above 2100. Or if you're looking at the monthly chart, it might be 2000. That's the most significant level. So looking at history from a bird's eye view, it tells us the probability of what's coming, and that's the S&P resuming this decline as there's a recession, falling into a secular bear officially, and then usually after that, soon after that, you'll see some kind of significant breakout in the gold market. So that's going to be gold breaking above 2000, 2050, and this 11-year base. I mean, you can still have cyclical gold bull markets when the S&P is in a secular bull. I mean, again, we got kind of lucky in the, well, I don't mean we, but I mean gold bugs, because nobody was really around in the 60s, maybe a few listeners. But I mean, that was one example. Another example was 85 to 87, and you could say August 2018 to August 2020. That was a cyclical bull, while the S&P was still in a secular bull. But we're setting up for a new secular bull in gold over the coming decade. And so, when this move that started a couple months ago, when it really starts to gain traction, probably early in 2023, I mean, it's going to lead to a multi-year cyclical bull market, but it's going to be part of at least a decade-long secular bull market. So I know that was a really long answer, but it's important to look at history and understand that we're setting up for a real secular bull market in gold. I mean, this is going to be much different than what we saw in 2016, 2018, or even 2020.
I feel like we need to talk about investor sentiment too, because quite frankly, investors still don't really seem to care about the gold market. Does this whole concept of a secular bear market in US markets, does that transfer over to the psychology of investors then changing more into gold? Because as much as we even hear right now that gold could finish the year in positive territory, I haven't noticed a huge sentiment change in terms of investors flooding into gold.
Yeah, it's really interesting. I think that's a really good point. I was talking to someone about this, a gentleman by the name of Mike Swanson, who studies this stuff, and he made a similar point that even in the early 2000s, and if we're just talking about like mainstream retail investors, not gold bugs per se, but mainstream retail investors, they didn't start to get into gold and precious metals and miners, he said, until 2003. And that's interesting because by 2003, the stock market, already had this bad, bear market. It was about to start a cyclical bull. Gold and gold stocks had already moved a lot. But it took that long of a time for mainstream retail investors to get interested in gold and precious metals. And so he was saying, we're definitely not going to see that happen, this time around until gold. I mean, gold is definitely going to be at a new all-time high. It might have to be at 22 or $2,300 an ounce before we start to see, based on that history, before we start to see, mainstream retail people start to realize, oh, gee, look at this has been going up for a couple years. Stock market, sucks. I got to put my money in gold. So that's one interesting part of it. But the other layer of that, Corey, is it's retail sentiment from, people that follow you and me and listen to shows like these. And the sentiment of those people is still kind of in the crapper. And that sentiment may not really improve until you start to see, I don't want to say it's a certain level for gold, but, maybe it's gold breaking above 1900 again. Maybe it's the miners, making another leg higher. Maybe it's, silver getting up close to 30 again. I don't know, but something, there has to be some trigger for that to happen when it's professionals in our industry, when everybody gets excited again. And clearly, we're not, I don't think we're that close to that happening. So there's that hurdle to overcome. But then there's also the mainstream, retail sentiment hurdle that I was talking about before, and comparing it to what happened in the early 2000s. That segment of investors, it's going to take a while for them to come on board. Like, you're not going to see that until gold first has to make that huge breakout above 2000 or 2050 or 2100. So, but the sentiment all around, it is really interesting. I'm seeing it anecdotally, even though I think the sector has put in a major bottom. Look, the apathy, that's another signal that we're going to be starting a secular bull market, because a lot of these people, maybe they've been in since 2011, and a segment of them have just gotten out of the market. They say, well, 2016, I thought we were starting it. 2018, I thought, 2020 again, I thought that we had this, this cyclical bear market. So a lot of people have been, washed out or given up or capitulated or whatever you want to call it. But that's just another thing that sets the stage for, a real sustained bull market in precious metals, and also a secular bull market. So the apathy that's there, all these anecdotal sentiment indicators, these are all signs. This is all what you see at the start of a secular bull market in precious metals. I mean, this is how it was in the early 2000s. Gold started moving up, miners had some huge gains, but nobody really started caring until 2 or 3 years after the fact.
It is true. It takes some time to bring investors back into a sector that, unfortunately, for quite a while now has been mostly ignored and somewhat hated. Jordan, what in your eyes is a secular bear market for U.S. markets, and how is that different than some of the bear markets we've seen over the last couple decades where it almost was a flash crash that then central banks jumped in and markets started to broadly recover?
Well, in a secular bear market for the S&P and U.S. equities or any stock market, it's basically a long period when the trend is, for lack of a better description, the trend is sideways or down. And if you're looking at a secular bull, the market consistently makes higher highs. So, and also in a secular bull, the market will break out to new all-time highs. So those are some really important components. So looking at the S&P, let's just presume we're going into a secular bear. And by the way, I think if we take out 3,500, like if the listeners want to pin me down and say, okay, well, give me some indicator level, I think if we take out 3,500 on the downside, to me, that's going to be confirmation that we're in a new secular bear. And so in a secular bear, what this could look like is, maybe this bear market, maybe it bottoms at 3,000, maybe it's 3,100, maybe it's 2,850. Let's just presume it's going to bottom around 3,000. Well, then you're going to get a cyclical bull that'll start in a year or whenever, and that could run for a couple years. However, the cyclical bulls, within these secular bears, they're not going to run as long as they usually do. They don't go up 300 or 400%. So a cyclical bull for the S&P, it could be, the S&P running up from, let's just at 2,900 to, I don't know, 5,500 or something. So the S&P could make a new all-time high, in the next 3, 4, 5 years. But it's not gonna sustain itself and extend, the way it did from 82 to 2000 or 2009 to 2021. So, you could get a move like that, and then there'll be another cyclical bear market where the market comes back down. And so that's typically what you see during a secular bear. Like, just the cyclical bulls they're not as long, and they're not as, the duration is not as long, and they're not going to be as big in terms of the percentage gains. So that's how and why it's going to look different. And during a secular bear, you also see valuations contract. And so you'll see these sky high valuations that we've been talking about for the last couple of years. Those will start to come down. So that's what we can look for in a secular bear and how it's going to be different. But, and thinking about gold, because a lot of people have said, oh, well, gold started a secular bull in 2016 or 2018. That hasn't happened because gold hasn't broken out to a new all-time high. Like it's not that wasn't a real breakout because it didn't sustain it. Gold is now back down below where it was 11 years ago, and you have the S&P still running up and making new all-time highs. So that tells you that gold has not been in a secular bull in the last 5 or 6 years. So I mean, I see people saying that, but that doesn't make sense, for those reasons. So that's how I look at the secular trends.
Fair enough. And look, yeah, the market's way higher than they were 11 years ago, even though they are off some of their highs. Gold, oh, well, that's still off of its highs from 11 years ago. Jordan, what does this mean for next year then? Because these sort of major shifts in sentiment, in the psychology of investors, take a while to play out. We've already been through pretty much a year of bear market action for U.S. markets, but we clearly haven't seen that shift in sentiment. While gold has rebounded, so have the markets. So, what does this mean for next year?
Well, I mean that's a very good point, and that's something I've been talking about over the last month or two. Is that there has to be a period where we start to see precious metals break away and not just outperform, but really break away and rise as the stock market falls, goes lower and a recession hits. And so, by the way, if you think the S&P is not going into recession this coming year and there's going to be a soft landing, that's not good for precious metals. Like if you think that's going to happen, then the secular bull for precious metals hasn't started yet. Like this would be another false start. So, but next year, and I think the first quarter, the first half, Corey, is going to be really, really interesting because we could see that the correlation between the two, at least on a shorter, medium term basis, really start to break. And it's again, this is something I've talked about for the last couple months. We need to see a real recession hit. We need to see the S&P roll over again, take out 3,500, because if these things happen, I mean, we already know the Fed is basically, maybe they'll hike one more time, but they're basically done. But if the market starts weakening it really significantly, and the indicators start to say or start to signal that a real recession is hitting, that's going to be the prime time when you can start to see the correlation between the two turn negative because the Fed will be thinking that they have to cut rates and ease policy in some way. And, at the same time, capital is probably going to move into precious metals when that happens. Initially you're going to see precious metals, gold specifically outperform, like the gold against the S&P will outperform. That initially that will happen, before later you see precious metals rising and then the stock market falling. So that's what I'm thinking about for next year.
Okay, maybe next year could be that actual transition year, more shifting investors towards the precious metals. We're going to see, but boy, oh boy, this year is really driving home the fact, I think, to investors that it is different. It's a different environment right now, and rates probably will stay broadly higher than where they have been, especially in terms of the direction of rates continuing to fall over the last 40 years. Now we're in a different environment. Jordan, thank you as always for your time, man. We'll chat next week. Have a great rest of your week.